Okay, good morning. Well, good afternoon, everyone. Welcome to the 2024 Portfolio Company Outlook and Pathways to Exit, presented by Fogel and Potamianos. My name is Christina Lowe. I will be your moderator today. A little bit about our panel today. We've got an amazing panel joining us today for the next hour. We have Todd Stavish, who is the vice president of the ventures team at SRI. In this role, Todd manages the overall operations for SRI Ventures, including incubation and deal sourcing. Prior to joining SRI, Todd was director of Lab 41, a division of IncuTel Labs. Under his leadership, Lab 41 developed novel deep learning algorithms, security for machine learning models, and one of the largest real-world audio training data sets. And previously, Todd was co-founder of Cosmic Q Works, an applied research lab focused on developing, prototyping, and evaluating open source artificial intelligence capabilities for geospatial use cases. He's received a bachelor's degree in computational physics from St. Bonaventure University. Welcome, Todd. How are you today?
Good. That was a mouthful, Christina. You did a good job. Nice to
Thank
be
you.
here.
I do what I can, you know. Thank you so much. It's a very thorough bio. I love how much experience that you have, and I'm so excited to hear from you today, Todd. We'll move on to Mickey Reynolds. Good afternoon. Mickey is the head of programs at Slauson & Co., where she develops and leads programs like the Friends and Family Accelerator that advance the firm's mission of economic inclusion. And prior to Slauson & Co., she was the CEO and co-founder of Grid 110, an award-winning nonprofit providing free entrepreneurship programs to underrepresented founders in partnership with the city of Los Angeles. She brings a fierce passion for supporting an inclusive community of entrepreneurs, having directly advised over 350 early-stage companies from idea to seed stage, led mostly by Black AAPL Latina and women founders. Welcome, Mickey. So glad to have you. Always love it when another female joins us on our webinars. I'm usually the only one here. So thank you, Mickey, for joining us.
Thanks for having me.
We've got Dr. Kyle Murphy. Kyle is a strategic servant leader with a robust track record of spearheading significant transformations across SaaS, tech-enabled services, and B2B service sectors, including fintech, AdMartech, Pass, and EdTech industries. His expertise lies in navigating companies through critical strategic transitions, expertly turning around operations, scaling startups into industry leaders, and driving technological innovation. In CEO and COO roles, he has scaled and revitalized multiple early stage and mid-market companies, leading to triple-digit growth percentages and successful exits. So glad to have you here, Kyle. Thanks for joining us today. Excited to hear from you.
Thanks, Christina. Happy to be here.
We've got Jerome Fogel, and Jerome is the co-founder here at Fogel and Potamianos LLP. He is known as a deal maker and innovator in the legal community and represents successful corporations, venture and hedge funds, and sports superstars. Jerome has a 360-degree view of deal making as he represents emerging companies raising capital, venture funds deploying capital, advisors and investors, and private companies in mergers and acquisitions. Hello, Jerome.
Christina, always glad to be here and see everybody here. It's going to be a great panel.
It really is. Thank you so much for just spearheading this, Jerome, and always coming up with amazing ideas and great content. We also have Constantine Potamianos. I like to refer to him as the sage. He has all the wisdom and all the knowing. And Constantine is the co-founder here at Fogel and Potamianos. He is an experienced business lawyer who has counseled public and private companies on a broad range of corporate and securities matters, including business entity formation, public and private offerings, mergers and acquisitions, securities registrations, SEC compliance, and corporate restructurings. A breadth of experience there, Constantine. Always glad to have you here, sir.
Thank you so much, Christina.
Can't wait to hear from you today. Well, I want to actually give the floor to our panelists. I would love to hear from you guys, just a brief snapshot of where you sit in this topic, and also just what are some really cool things that are going on with some of your companies. I'd love to hear from Mickey. Let's hear from Mickey first.
Thanks, Christina. So again, as Christina mentioned, my name is Nikki Reynolds. I'm the head of programs for Slauson & Co. We're an early stage venture capital firm rooted in economic inclusion, primarily based in Los Angeles, California. We invest in pre-seed and seed stage companies that typically fall into two areas under the economic inclusion umbrella, culturally aligned consumer and small business technology. I get to sit even earlier in terms of stage. So I lead our Friends and Family Accelerator, where we're writing 150K checks into kind of later idea stage companies, kind of early pre-seed, and just actually wrapped up our 12-week accelerator program where we worked with 20 companies. So that's a little bit about us.
Amazing. Thank you so much, Mickey. Todd, let's hear from you. What's going on in your world and what's exciting with some of the companies you're working with?
Okay, well, I'll just add to my elaborate introduction and talk more about the organization than myself. But I work for SRI, Stanford Research Institute. We're a large R&D company, spun out of Stanford just to do dedicated applied research. And so we're also early stage, invest to up to 250K, pre-seed, seed. We also inject intellectual property from our parent corp, and it can be anything from robotics. We did synthetic chemistry last year. Obviously AI is part of probably every portfolio in existence. There's a lot of AI going on. And so I think this year what is strategic and somewhat fortunate, just luck, we're moving into sustainability investments. So we're gonna do a hydrogen separation deal to make the environment a better place and generate some energy. And we're also adding machine learning to make buildings autonomous so they can measure and control energy and temperature. So very exciting and good ventures for us this year.
Amazing. Thank you so much, Todd. And Dr. Kyle Murphy. Kyle, how about you? What's going on in your world?
Yeah, well, I split my time, just so people wondering why is there a doctor. On one side, I'm a professor of strategy at Pepperdine Grazia Business School. So that's one of my passion project is also my side hustle. Love working with the students and for it. But my day job is right now I'm currently the CEO of Degrees of Interest. We're a visual analytics AI company working in the criminal investigation space for law enforcement. It's a spin out of another company. It's going through an exit right now for it. And this was a separate technology. It made sense to be on its own for it. I also sit on several boards in the private equity space for it. So my perspective is a lot of the lower mid-market emerging scale-up companies and kind of what's going on with that space.
That's a excellent segue, actually, Kyle, to kind of one of the things that we want to talk about here, which is, we as kind of a starting thing, we want to hear from everybody kind of what you see currently in the fundraising and exit environments. And as you mentioned, one of your companies, the parent of the spinoff, is going through an exit now. So maybe tell us a little bit about what you're seeing in fundraising and exits, and then we'll ask the rest of the panel as well.
Yeah, happy. It's changing. If the word disruption ever was hit, this was it. And neither in a good or bad way. It's just, I think we're seeing a maturing of the overall, and I'm in software, primarily software industry. And I think it's going to go through some evolutions. You obviously got AI, which was much like the .com, is going to add a whole lot of pieces for it. But what I don't think a lot of people understand in early stage fundraising is there's an outlet, which is exits, whether it's to private equity, strategic M&A, or IPO. All of them were very quiet the last 12, 18 months. It's picking back up. This is the good thing. We're seeing more private equity deals going on for valuations are reset, which they needed to happen. Again, part of the reason, the cost of capital. IPOs are starting to open a little. Again, those are for bigger companies for it. But I think so. For those who are at the stage where they might be thinking about exiting, I think there's just has to be a reset of what valuations are. And there isn't going to be a reset to what we were 2-3 years ago in the next 2 years, right? This is where we're at. And it's probably going to be there for a while. And so people are going to have to get much more serious about if they want to exit the company, what is it going to take to get there? What condition does their company need to be in? Now, for the early stage fundraising, which I'm back into right now, is like the status quo is gone, and there's never been a status quo investing, but you can kind of go there's seed, pre-seed, and all these standards and who you went to, and it's the goalposts have changed, but the problem is that no one knows where they are. I talked to one person that says this and says this, and I'm like, you guys are investing in the exact same deals, and I just got before it. And so some of the early stage companies I'm advising, we're going really non-traditional. We're doing a lot more discussion with potential partners and strategics, whether it's venture type funding out of corporate venturing groups, or just, and I like it. We're getting a little more down gritty, starting with less, proving the model better. And yes, does it slow down growth in the first 24 months? Yeah, but long-term, it doesn't affect the company. I think it actually makes better companies. So I think you're gonna have to get a lot more creative where you're gonna find your early stage monies. You're gonna have to do less with more. I mean, you have to do more with less for it, which in all, I think is a good sign of the startup community.
Yeah, I agree with everything that Kyle said. I would say early stage, anything generative AI raised quickly and well at good valuations. We saw early stage that had sort of higher CapEx demands take a lot longer to raise than they usually do. Portfolio, the later stage kind of fundraising, a lot of extensions. And the ones that did jump to the next financing took longer than longer than we all expected. And then on the M&A, we generally see a little bit more than most portfolios because we have captive IP and strong tech teams, so they are acqui-hire targets. I'd say that's about normal, but lower numbers than usual. And some of these companies could had runway and might have gone out earlier just because they were unsure about future financing. So I would say it's good, not as bad as it was, and seems to be getting better.
Mickey.
Something that
Oh,
yeah,
I'm
something
sorry. I was going to say, obviously add to whatever Kyle and Todd are saying, but I'd love to hear your perspective, outside of kind of the hardcore tech sector where Kyle and Todd kind of focus to see about how it is in some of the other markets.
Yeah, Kyle had mentioned, having to get creative with financing and partners and opportunities. And I think something that I've seen just working across a very diverse array of different types of businesses, from CPG to SaaS as well, is alternate types of capital and kind of the capital that makes the most sense for the type of business that you're building. Working with a lot of CPG businesses that are going into retail, it's a hefty capital expense in order to produce the inventory that's needed, and to produce it months in advance of getting paid. So are there capital partners that kind of make more sense for that versus venture capital? So whether that's kind of inventory-based financing, PO-based financing, seeing startups that are building around that, of being kind of a bridge to or a discovery platform for different types of alternate capital opportunities. The other thing that I'm seeing some kind of talk around is let's raise once and then never have to raise again, because we don't want to be committed onto this fundraising hamster wheel where we're going to raise and then we have to raise more and then have to raise more, and the expectations of growth around that. So I think companies, because of the past few years and the focus around revenue and profitability, which I feel like is a bad word to be used in startups, but is becoming something that is much more top of mind, is how can we focus on building a sustainable growth business that will actually, continue to live on, and what is the capital that is needed for that, and is there a minimum amount of capital needed, and then being able to use other types of growth levers to continue the process. So those are a couple of things that I've seen just discussions around, whether it's on Twitter or within kind of the groups of founders that we're working with.
Given the scenario and the market conditions that you guys have outlined, what do you think are critical factors for companies to keep in mind as they're preparing for a fundraising round now, in the tech sector, but also outside of the tech sector? Let's say, what are the top 3 pieces of advice you would give to a portfolio company getting ready to try to fundraise?
Know your metrics and live them. What are those 2 or 3, unit economics that drive the company? and then tie that to your pipeline and your marketing activities and tie it to your retention. If you can't talk about it, people don't really, you start to lose credibility really quick. I don't care how successful your company's been. When you're getting into the finance, particularly the later rounds, there's a level of sophistication. You have to be able to understand your business model. I'm just seeing a lot of deals fall apart. I mean, even more mature companies getting at an exit, and they walk in, and then the private equity guys or whoever's acquiring walk away and go, might be good, I just can't even tell. And the risk.
Yeah, a lot of entrepreneurs, in my opinion, sometimes get tied up in the enthusiasm and the fast talking, and they kind of get ahead of their skis. Because at the end of the day, you still got to explain your business in number terms if you want people to invest money in it, is what I've seen over the years. And it's always been my approach, in other lives where we were actually investing in companies. It's like, okay, interesting idea, but show me the numbers, show me how that makes sense. So I think that goes to your point, Kyle.
I would add too.
Oh, sorry, Jerome.
Oh, sorry, Mickey, please, you go first, then I'll go.
That was going to be the one thing I said. There was a tweet that went viral maybe like a month or so ago around pre-seed raises and investors requiring financial models. And is that like, what's the validity in that? Is it actually a requirement? And it was kind of split decision of people being like, the numbers are made up, so it doesn't really matter. But then the investors it's more like, how are you thinking about this? And we want to understand, do you understand your numbers? Do you understand how you're planning on making revenue? What are the different streams? It's really more of like a thought process question. And so it was something that we hammered home in our own accelerator, even having pre-revenue, in some cases, pre-product companies. It really is to showcase that you have a vision for what you're trying to do, and you have some semblance of numbers that you put together, even if they are made up in some way, that you have something that you can go off of. And so once you actually get real numbers, revenue, customers, you can start plugging those in and things start to make a little bit more sense. But just going through the exercise of it, we feel like is really important.
Yeah, I completely agree with Kyle and Mickey. That brings me, I think the one point I would say is you need the correct group of directors at the company, because they can really steer you through the different fundraising cycles that you're in, and they can help you steer through complex environments, situations like now. So for example, I was talking to a founder who's about to go Series C, and it just realized, the board that got to Series A and B is just not going to be the right board for Series C. You got to move some pieces around because it takes different skill sets. Working with a VC who they just had to off-ramp somebody off the board who's being very disruptive. And maybe at the seed stage, they kind of could put up with that, but now they got to go for a Series A, and they're going to have more institutional investors. And so I just think that, the board sets the tone at the top. And if I look at all of our companies we've worked with, the quality of the board really can really elevate whatever they're doing, help them raise, help them figure out their numbers, help them deal with management issues. So I really think the quality of the board is super important, and having the correct group of directors at the correct stage for where you're at.
Mickey, you said something else which was interesting, which is some companies are trying to do, kind of a one and done. It's like, okay, can we bring in enough capital that allows us to then self-fund going forward? Which is great if you can do that. But the flip side of that I've seen, historically, and particularly kind of in difficult financing markets where the funding sources can kind of dictate the terms more aggressively, is that I've seen companies say, okay, X amount will get us through, to the next level. And we've kind of calculated fine, and it's just X amount. So we're going to take just X amount and take the minimum dilution, because we want to avoid this. It's a difficult market, et cetera. And they end up running out of gas far sooner than they think. So one thing we always told people, and please guys, if you disagree, chime in, But we always said, if somebody is offering you some extra dry powder, even if it's at a little bit more expensive price, always take that, because your estimations of what you think is going to take you to get to the next level is probably going to be off some. Don't worry about that incremental dilution now. Take the capital in, use it wisely, but have that buffer available.
I agree. Yeah, we didn't. I mean, that kind of that logic has ebbed and flowed over probably the last 20 years. But I think right now it's very accurate, and I think it's going to stay that way. I mean, it's been for it, which is take more now and then hopefully not do another raise or extend it, because the increase in value you can add to the company by delaying is worth the small additional, dilution you get now. And the other problem is just the raising capital and selling your company sucks all the energy out of the management and the focus. And then if it goes wrong, I mean, the recovery is, and just the momentum of a company is so important. So if you're going to have to raise money or sell, be aware this is an extremely risky time for the company, not just cash flow, that the energy of the company is going to get sucked out.
Yeah, Kyle, your point is absolutely correct. We've seen it time and time again. People completely underestimate the time and effort that goes into fundraising or an exit, and we've seen companies suffer operationally during this period, where everybody is focused, or at least, the leadership team is focused on closing that financing round. And we've seen the rest of the business actually slip during this. Todd, I don't know what your experience is with some of the portfolio companies you've worked with over the years, but this is kind of what we've seen.
Yeah, I mean, some of them, when the bubble popped, did some, painful cost cutting. I'd also agree on both boards and sometimes the management team of the startup need to change depending on the maturity. And then just to circle back with some of the early things discussed on, the expectations at stages. So all the lettered rounds, like if you're not in the window of your revenue expectations, it's real tough. I think the early stage where a lot of us play, they expect more than the hockey stick and then the $1 billion TAM. We haven't done much on modeling revenue seriously, but even at the pre-seed level at the ones I discussed in the energy space, we have 3 reputable design partners signing LOIs to say, we could use this. This is something we'd be interested in if this startup was funded. No revenue commitments, no business commitments, just like an acknowledgement that it could be useful to another business. And that's been really helpful. And then I think just a way to describe your go-to-market with some idea of how you charge that's thoughtful. That's been enough for us in the pre-seed where there's no chance you having revenue that early.
Yeah. That goes to what Mickey said, and which I think always made sense when I was sitting on the investor side, which was, all right, convince me that there's logic and thought behind this. You have a great idea. How are you going to implement it? Yeah, we might see projections, and yeah, we all discount it as basically, a work of fiction at this point. But if you can convince me that the logic behind it makes sense, then I can see a path that you can actually actualize. Good. Talking about fundraising, it's actually good to now maybe turn the discussion around and say, okay, from a company standpoint, what are the good things and the bad things about dealing with different levels of financing? And maybe perhaps, one of the big ones is, the typical VCs, and recognizing that we're generalizing here because like anybody else, VCs run the gamut. But for you guys out there dealing with this on a daily basis, kind of what are the good things that you see that VCs are bringing to the table? What are some of the bad things that you see that some of the more predatory folks out there are doing? And what are the things for portfolio companies and young companies to watch out for as they start talking to folks?
You know, I mean, besides the money, that's the obvious for it. I think the VCs, I look for two things. One is what doors can they help open, whether just through planning or they actually can help find the right people or they can open themselves. You know, help us go for it. They often promise more operational or I just don't need it. I mean, most of them aren't operators, so
Yeah.
it's nice if you know someone that can help us. But much more that open the doors. The other thing, and this is something new, but I think they're becoming much more aware of it, is you're a founder, particularly the CEO, it is one of the loneliest jobs. And the amount of mental health and burnout that's happening is hurting the industry. I mean, we're having a big problem, and I've faced it myself. I'm not ashamed, and I've seen it. And the good ones are like therapists, right? They're like a leadership. I'm having discussions. I'm venting because I have no one else to vent to. I called my VC. He lets me vent. He's like, cool, all right, and it's gone because he knows what it is. And I think we all need that. But and then gives good critical advice. Calls me out and goes, no, I think you're wrong. I'm like, okay, different than a board, right? It's a different type of relationship. They really are on your side for it. The negative ones, I think the ones with the problems, and I'm seeing this on a couple of boards I've sat on, are the ones that get hyped. They get the VCs are too affected by the market, right? We got AI's everything. Like, we're not an AI company. I mean, we're using it, marketing for, no. And we literally had to hire an AI person that came in. It was just this crazy nut. They're following it. I'm like, tell me the business logic. Why are we doing this? The other one is arbitrary setting growth goals that aren't related at all to the market and the company potential. I remember the Rule 40 when I first heard it. I was like, what is that? It was a VC firm and like, oh, this is what we got to do to get a private equity firm to buy it. And I'm like, been in private equity for 8 years, never heard the term. I understand it now. I understand the logic, but I'm like, there was no logic in that company ever hitting that Rule 40. It was not going to happen. And they ended up destroying the company because they pushed it into a place. Like, by the way, this was a $27 million company. It was highly profitable. Could have sold it right then and everyone would have had maybe a double. But, it was like, got to have the home run. I'm like, I get it. I understand the model, but too many companies are never going to have that home run.
Yeah. Absolutely. Todd, how about your perspective as a VC going out there? I mean, what's your best practices as a VC towards portfolio companies? And what are the things that you shy away from that you see other VCs doing?
I mean, this is not just VC, it's on the entrepreneur side too. Trying to game the pricing. It's like, if you play one investor against the other, they'll always talk to each other, right? So credit your company value, you just make yourself look bad. I mean, maybe people have won that. I've never seen a successful entrepreneur winning that. And then with the investor side, yes, sometimes, especially now in slower fundraising cycles, they'll try to knock the value of the company down. But generally speaking, if you like the company, you'll find some, a band of agreement. I think too, have a wide net. Kyle mentioned the CVCs; they are leaning in earlier. I've even seen the crossover PE firms come in earlier than you expect them to. In fact, we had one startup. Won't name the fund. They're very big. They reached out to him and he's like, "You're not interested in me." And they said, "Yes, we are." And he was just focused. He had a nice set of smaller investors interested. And finally, he's like, "All right, I'll talk to you." And it looks like they may invest. So
nice.
Don't prejudge. And this goes the other way for the smaller investors, right? Like, if you have some tier ones there, maybe a smaller investor, a CVC, could be a better, and not just for the cash, but for the guidance in the syndicate. So keep an open mind. That's what.
Especially if you have folks, I mean, to Kyle's point, a lot of the VCs are not operators, but if you have some smaller investors that are operators in your sector, there's a lot of value that they can add, and they're not asking for anything. They're just excited about what you're doing, hope to make some money off their investment, and they're usually happy to put in their 2 cents worth and help out the management team if they can.
Great. Angels can be extremely valuable. I think they're often been discounted as you get the good ones. They're willing to put in sweat equity just to help you, right? Because they got money into it, but they often are operators that are playing in that. The other one, just real quick, Todd, I think good point, is private equity is coming down market. It has been for a while, but some have actually converted almost to being growth equity players. The firm I was at actually went that way. They created a whole fund just to become essentially growth equity at the lower, I'd say SMB, not even lower mid-market.
Now, one thing that we've all kind of talked about here, but obviously in a changing environment, companies need to be able to pivot, to adjust their model, etc. Mickey, you've probably seen a ton of this, particularly at the young level where companies are still trying to figure out their business model and what actually works. Let's talk a little bit, if you guys don't mind, about what are some of the pivots that you're seeing? What are effective methods of pivot? How does that then affect fundraising, both past and future, and how investors look at a company that needs to pivot?
Yeah, we've definitely seen it a lot at the early stages, and in particular in the accelerator, when you've got people that are maybe still tinkering on ideas, maybe have some customer validation, but aren't fully sold on exactly what the product should be. And we really invite them to use the accelerator, the 12 weeks, as a container to kind of fuck around and find out, for lack of a better phrase, of just experimenting and iteration, getting feedback, talking to your customers. And if the data that you're getting then kind of illuminates maybe a different pathway or a reprioritization, the product roadmap that you're focusing on, then let it be used for that, because that is the best use of that time, and to really make sure that you have a solid foundation where you can move forward with. So we've had a couple of companies who've done that kind of over the course of the accelerator. We've had some that have just uncovered maybe larger opportunities with reprioritizing a different channel. So going B2C versus before going B2B, or doing them in tandem, but kind of prioritizing something different. So not necessarily a hard pivot, but just kind of a reconsideration or reprioritization of what they're looking for. And then we've definitely had companies who, because of changes in the economy or the market, whether it's the pandemic or the writer's strike, had to kind of completely implode their businesses, but treat it as a sprint. And it was like, we have a finite amount of time and runway to really figure out a new direction. And can we do it with the same team and maybe the fundamentals of the foundation of the product that we've built, and have uncovered a much larger opportunity because of that setback. So even though it can take time away and you burn a little bit more capital, if it ultimately results in a much more sustainable opportunity or a larger opportunity, I think that that's definitely a consideration that you should make. And it's why we're always telling our companies to be talking to their customers continuously. And customer discovery and validation is not something that you do once. It is something that you should continue to be doing, because different, when you get from 100 customers to 1,000 customers, there may be different pain points that you're solving for, and to always be keeping those things in mind.
Todd, I think, folks are naturally a little hesitant to go back to their funding partners, et cetera, and say, hey, this particular path we were going down doesn't work. It's what we sold to you, but, we think we need to go down a different path. How do you, on the VC side, how do you handle that? And what advice would you give to portfolio companies?
I mean, that's, if you know what's going south, tell your board right away, right? Because if they believe in the tech and they believe in the team, they'll likely bridge, right? I mean, depending how bad it is, qualify that. But and you kind of know at the board. I mean, you keep getting the updates, and you're not seeing any sort of new changes or customer engagement. So the board is usually not surprised. But don't be afraid to pivot. I mean, ours are highly technical, and so there's this tech debt, right? It's almost like when you invest in the public markets and you buy at a price and you see the price going down and down. So it's particularly hard for us in our companies because they spend a year developing a robotic system or something. But there's one of our robotics company that was at B, and just great tech, great team, but just didn't have even close to the revenue that they needed for even an extension or bridge. So swallow the medicine as early as you can and make the corrections. Because you can honestly change your trajectory. I've seen it a million times.
Yeah. And look, I mean, some of the most successful companies in history have gone through a number of pivots. It's nothing to be ashamed about, and you shouldn't wed yourself to a particular business strategy. The the most brilliant companies are able to adapt to market conditions and take advantage of what they have to bring to a new marketplace. And Kyle, you're probably best suited to speak to that.
Well, yeah, and we often talk about pivoting. Obviously, is generally changing something in your business model or maybe your strategy for it. But I think it's the goals we're changing, right? Which is Maggie talked about sustainability is the very arbitrary, super high growth or unrealistic growth. We're going, okay, let's come back to it and go, what is this long-term growth? Because the value is actually better. We're starting, seeing better IRR investments type of deal for it. So I think when you're looking at pivot, it's not just the business model or my strategy. It's also what are the goals we've set? Maybe we need to reset those, which also means we might be able to cut a lot of our costs.
Yeah.
Because I think a lot of cost cutting is done out of knee jerk, and I'd rather do the cost cutting and going, where are we changing the goal to? We all agree on it, the board of investors, and go, okay, now what does this company need to look at? And I mean, honestly, it's leading to much leaner companies, and I mean, obviously that means a lot of people may be losing their jobs, which of course is a negative, but the positive is companies are going to survive.
I think too, what we're seeing in terms of on the pivoting side, private equity or VC backed firms that are just realizing, okay, we bought this company with the idea of adding debt onto it and selling it, or we invested in this company, but for whatever reason it's just not working. And so then I think that there's successful platform companies out there that are now essentially taking on those companies. And so the private equity firms say, okay, we'll take a loss here, take a haircut, or the VC says, okay, like we're just going to have to let this one go as one of the strikeouts. 10 at bats, we're going to have 7 strikeouts or 5 strikeouts. So I think we're seeing that, and so I think that there's an opportunity for these larger players who've got the capability, they've got a platform secret sauce that works for them, to go out and pick up some of these companies that are coming to market, because I do think there's pressure with the amount of the cost of leverage is not the way what it used to be. So I just think that there's opportunities out there where some portfolio companies are going to just get gobbled up by platforms, and because we're seeing it, and I think that there is an appetite to see the value of what these companies have built. They just couldn't get across the finish line, but there's value there, and I think companies are seeing it, and we're seeing on our end at least a couple different clients taking advantage of that.
Yeah, I'd jump on that too. I think, on the leanness, we've seen small teams do more, historically more than they did in the past. Teams of 5 or 10 using some of the generative tools to reach $1 million ARR, which is kind of incredible. And then sort of on the appetite for future M&A, I've heard through the grapevine some of these massive sort of platform LM companies that have raised hundreds of millions do eventually plan to do heavy M&A. And so if you have sort of, we've invested in M&A, or sorry, LMs or generative tool companies that like assist in that. So there could be a wave of acquisitions in that space in the short term.
Now, I will say I've been thinking about something, briefly before we started this webinar, we were on and kind of chatting about working smarter, not harder. Kyle, we were having that discussion, and we talked about the intense effort that goes into a fundraising and exit, and now we've kind of talked about being lean, right? And it's like I've been thinking about this as we've been discussing it, and I think there's something else that's important to raise with companies, and that's the way you do all of these things, or one of the ways you do all of these things, in my opinion, is that you establish a good foundation from the beginning. You do things right from the beginning to make things easier down the road. And it goes to some of the really kind of boring and mundane things that no founder wants to think about. They're focused on, what exciting product am I bringing to market? Who can I sell it to? This, that, and the other. But there's a whole host of things that folks like Jerome and I and others deal with in setting up companies for success that start with how the entity is organized, what its corporate structure is, and what its capitalization is, how contracts are set up, simple things like, are all these contracts automatically assigned in a change of control environment? Yes, great. If I'm the acquirer, if I'm there, looking at this company for an exit, and you tell me all these contracts automatically assigned, I'm like, beautiful. Versus, oh, you need to go out and get 1,000 third-party consents to assign this. I'm like, okay, guys, when you do that, come back and talk to me, right? There's all these things that can be put in place along the way. So you have this foundation to really have smooth growth, smooth fundraising, and a smooth exit. I mean, Todd, you can probably speak to this. There's situations where you've gone in to fund the company and it's taken longer than expected because, hey, there's a bunch of stuff missing that you want in place, that you want to see before you cut that check. And Kyle, from the private equity standpoint, I'm sure you've said, oh, this is an exciting company. And you start peeling back the layers and you say, all right, we got to clean off all this hair before we do this acquisition. And that affects price, and that affects timing, and that affects all kinds of things. So it's really boring stuff that no company and no CEO wants to deal with. But when you put this stuff in place, I think it really makes for a much smoother, leaner, and smarter way to go about your fundraising and your exit down the road. I figured I'd just throw that in there because companies don't think about that stuff, but it is sometimes obviously not as important as the baseline business, but it sure makes a difference when you're trying to raise money or exit out.
Yeah, I mean, you all are great attorneys. But we have technical co-founders that don't want to use attorneys. They'll form their Delaware C Corp through a, filing as a service, an API, everything is API, and then, our lawyers, because we're doing IP licensing, look them up and they're like, they're not even Delaware C Corps. It's like Minnesota Inc. or something, great state, but, everyone kind of plays in another one. So, hire an attorney, because, when you go to after us, we now introduce you to sort of, larger VCs, because we're kind of the first, professional investor usually in our companies. You have to look legit. You have to have all your documentation in place, and because that is a signal that you aren't professional, and anything that is negative connotation for investors, you want to look completely like legit, standard, and fully formed, because they're potentially writing a check for millions of dollars to you.
I mean, sitting on your side of the table, Todd, when we were looking at investments, it's like, okay, you go through your standard due diligence process and you're looking at companies. And if they come back with a bunch of holes or this flimsy documentation that doesn't take them from, formation till now, you start thinking, okay, what else is not done right here? What else are we going to have to fix and deal with? And and it affects what you offer people and how excited you are about a deal, so having that foundation right, so you could say, bam, 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 here you are, everything's solid, from your side, you check the boxes and say, okay, let me continue to be excited about this business and what they're doing. They've taken care of all the other stuff.
A shocking, shocking statistic for people going through an acquisition. So I'm not funding acquisition. You get an LOI, a lot of people go, this is great. Those fail 75% or more of the time. There's not exact statistics, but it's high. And that's our numbers, my agencies or my private equity for it. And it's because there's hair on the deal, right? It's just not well put together. I think there's a lot of talk put together about scaling up companies, right? Because that's sexy and fun. We're scaling up experts, and they hire those people. And I've been promoting the whole thing. Yeah, maturing up. You know, particularly if you're looking for exit, you need to mature up, which means you also need the team. And normal question is, oh, we can't afford it. I'm like, yeah, you can. They're called fractionals. You don't hire what you can afford anymore. Hire the right person and just pay for the hours you can afford, because that quality of person is going to afford it. And I think that's a big change in early stage companies now, is we hired people. A lot of them were just way too junior, not qualified. Now no, this is go get high quality fractional people at high level management, and then you're in a better spot.
And the truth of the matter is that we found we've done a lot of cleanup over the years for companies, but invariably it costs you a multiple what it would have cost you had you simply done it right to begin with. You know, when you're trying to clean at the 11th hour, 59th minute, and you're trying to get a deal done. So it is what it is. But that's my 2 cents of advice in terms of ensuring a smooth fundraising or a smooth exit. Now, I don't know about you guys. I think the market conditions have gotten a little difficult. Certainly things have changed. But I also think it's a very exciting time for companies. I think there's a tremendous amount that can be done. I think there's amazing opportunities out there. What do you guys think? I mean, obviously the market moves through sentiment cycles, but I think despite some of the difficulties, there's a lot of potential out there.
I mean, yeah, to me, I've always believed the best opportunity is when there's times of disruption for it. It's the harder, but if you look at the last 30, 40 years, really, almost, if you go, the big companies that have come into existence, they've come out of those, right? The financial crisis led into, just Square and Uber and a lot of these different ones. The .com led to a whole bunch of different companies. And there's also all the layoffs. And while negative if you lose your job, those are a lot of people are going to be looking and trying to solve problems and are going to build good businesses. So I think, and I won't say the lack of money, fewer, it's not as abundant, is actually going to lead to probably better discipline built companies. I think we're starting to see some of the AI blowout, which we knew was going to happen. There were just so many. There were over 1,200 companies that got funding, and most of them didn't even have AI. They were just some add-on, and they're going to blow out. But out of that is going to be some really good companies that have really built, good tools that are creating value for companies or their customers. So I think it's a great time to do it. It's just not going to be as fun and sexy as we've been highlighting, where you're going out and seed raising $10 million. I mean, I remember the first time I heard that, I was like, this is worse than the .com. I don't even know what this is. But now people are talking about seed at 750 or 500. I'm like, yeah, that's a seed round. That feels right to me, or less.
Yeah, I agree with Kyle. I mean, the benefit of these hard times is the quality goes up. I think during the bubble, it just felt rushed. Now you can slow down and make sensible decisions. So it's a really good time to be an investor right now, I think, and an entrepreneur.
Very good. Well, we're going to go into our Q&A. You guys have actually covered most of the questions you're being asked.
I want to add one note about difficult times. So for those who love golf, the U.S. Open, this will make sense, I promise. The U.S. Open is notoriously a very difficult, challenging course. And the criticism sometimes is it's too challenging for players. And they said, we're not trying to filter out great players, we're trying to identify them. So what I mean by that is, when you're playing a difficult course like this market, you can identify the really great players, the really great VCs, the really great founders. So this is a great time to identify who those really are. Because like Dave Ramsey says, even a turkey can fly in a tornado. So, now we can figure out who they are. Sorry, Christina, now you're up.
No, that's great, because that's a great segue into one of the questions, which is, what do you look for in founders when you invest?
Any one of you guys, you all have insights.
Two things is, at least for me, one, domain expertise. I just don't touch, I teach MBA. So with the MBA with an idea, they can solve the world, but they don't know anything about that industry, don't have any access to it. I just have really had poor results around that. And the other thing is how committed they are. You know, if they're thinking about, do I take a job or do the startup? Or if there's questions about how much they're going to commit now, when it hits the hard times, which it always will be, you know, they're just not going to have that level of tenacity to get through it. And so those are the two things I really look for.
I'll just add to that, we need a strong technical co-founder. We're in deep tech. And then on the CEO side, I'm not really looking for an operator. And sometimes we have a technical, quasi-technical co-founder that ends up being the CEO, someone that can fundraise. It's an art. Your personality has to be suited to it. You have to take direction from, you know, the early investors, and then listen to the objections and address them in the next pitch you do. And so it just takes a special kind of personality, and you got to kind of figure out if they can do that or not.
For us, really related to the founder profile, we believe that your personal lived experience is your competitive advantage. And so whether that is domain expertise or just a personal lived experience in a particular space, experiencing a problem firsthand, knowing it intimately, and being really passionate about it. And this is the thing that you're going to wake up and want to solve every single day. So that, and I think coupled with just being resourceful. So we work with and have invested with a lot of primarily underrepresented founders who have to do a lot more with very little. And they are used to stretching dollars. They are used to kind of haggling, trading. And I think the ability to attract a strong team is really important too. So whether it's being able to convince people that you've worked with previously to come on board, trade for sweat equity, whatever it might be, even if you don't have them on board just yet, if you've at least been able to identify the type of talent that you would bring on once you've been able to complete a raise, I think that those are really important qualities.
I would add, keep everything Kyle and Mickey and Todd said. I would add a looking for a reservoir of humility, because that's an antidote to hubris, which is really what takes these founders down when they're not open to feedback, change, criticism. And, you know, that would be my add to what they wonderfully said.
Constantine, any other additions?
No, I mean, I was just thinking about what Jerome was saying, and it's really kind of funny, because the people that are truly confident in themselves are the ones that are typically the most open towards feedback, right? The ones that display kind of a false confidence, I know this, I know everything, are the people that you can't reach. And you guys just reminded me of something. When we were sitting there making investments in companies, and I would talk to different people. One of the executive director of Techstars here, that I was a mentor for the Techstars program, and we were just talking about companies. And he said, I asked him what he's looking for. And he said, I'm looking for CEOs that are coachable. I want somebody that I can help improve and grow. If they're not coachable, I got nothing for them.
Well, guys, we are actually coming to a close right now. And I just want to say thank you to all of our panelists here for your time and expertise. I want to end it on something that Kyle said in our intro Zoom, and that is, just because you build it doesn't mean that they're going to come. And I think that just what everyone's offered here is such great advice for everybody from the entrepreneur stage all the way through investor stage, that, there's a lot more that goes into this to set up a company for success. And so thank you guys, everyone, just for your expertise and your time. This will be recorded, and we will be sending it out to everyone that registered and attended. Please feel free to share this with anyone in your world who could benefit from this. And we just want to say a big thank you to everyone that came and registered and gave their time today. We appreciate you all so much. If you have any further questions, please feel free to reach out to us at info@fpgeneralcounsel.com. And we hope to see you all again real soon. Have a great day.
Thank you, everyone.
Thank you, everyone.
Thanks, everybody.